Trying to plan for the 2026 market can feel like staring into a thick fog, right? You just don't know what's coming. Well, today we're going to lay out a game plan that isn't about having a crystal ball. Nope. It's about having a dynamic, flexible strategy that's ready to pivot no matter what comes our way. Let's dive in.
So this is really the million-dollar question, isn't it? How can you possibly invest with any confidence when the future is a total unknown? Well, the answer isn't about predicting what's going to happen. It's about building a smart system, a framework that lets you react intelligently to whatever the market decides to throw at you.
Okay, to build that framework, we need the right tools. I want you to think about your portfolio like it's a high-performance car. You've got your reliable engine for that steady, long-term power. You've got a turbocharger for when you need a quick burst of speed. And of course, you've got a solid set of brakes for when you need to play it safe. First up, let's talk about the engine. That's QQQ. It's an ETF that basically holds a basket of the 100 most innovative companies on the NASDAQ. This is your foundation, your workhorse. It's designed to capture that big, powerful, long-term growth we're all after. It's the core of the whole operation. Next, we've got the Turbocharger QLD. Now this is a 2x leveraged ETF. What that means is it's designed to give you twice the daily return of the NASDAQ 100. And I really have to emphasize that word daily. This is not something you buy and hold forever. It's a tactical tool, something you use for short, aggressive moves when you think you see a clear shot.
And finally, every car needs good brakes. For us, that's SGOV. This ETF holds super short-term government bonds, so it's an excellent stand-in for cash. It's your safe haven. When things get choppy or uncertain, you hit the brakes, you move your money into SGOV to protect it, and you just wait for the right moment to get back on the gas. And this right here is probably the most important distinction we're going to make today. QLD, our turbo, resets its leverage every single day. This creates something called volatility drag. Just imagine the market goes up 10% one day, then down 10% the next. Because of the daily reset, a fund like QLD can actually end up losing money. That's why the takeaway is so simple but so critical. QQQ is for holding, QLD is for trading. So we've got our tools, right? The engine, the turbo, the brakes. But how do we decide when to use each one? Well, that all comes down to controlling one single metric, and this is the key to the entire strategy. We're going to control our risk using a concept called beta. The easiest way to think about beta is as your portfolio's risk dial, or maybe its gas pedal. If your portfolio has a beta of 1, it moves right in line with the market. If it's less than 1, you're being more defensive. And if it's greater than 1, you're pushing on the gas, you're taking on more volatility for the chance at higher returns. Throughout the year, we're going to be aiming for specific beta levels, and during our most aggressive phases, that target number might look something like this, 1.3. But what does that actually mean in plain English? It's actually pretty simple. A beta of 1.3 just means we're aiming for our portfolio to be about 30% more volatile than the broader market. And here's how we do it. By carefully mixing our 3 tools, the engine, the turbo, and the brakes, we can precisely dial our portfolio's total beta up or down to match whatever the market is giving us. So here it is, our high-level roadmap for the year. But don't think of this as a rigid, set-in-stone schedule. Instead, think of these as key checkpoints. Things like Fed meetings, earnings season, and really powerful historical patterns that are going to tell us when it's time to reach over and adjust that risk dial. All right, let's start the year. We are not coming out of the gate swinging. Instead, we're starting with a strategic defensive posture. The goal for this first quarter is really simple. Protect the money we made last year and just get a feel for the new landscape before we start taking on any big risks. And this chart shows that defensive stance perfectly. Our target beta is just under 1 at 0.95. And look at that big 20% slice allocated to SGOV, our brakes. We've still got our foot lightly on the gas with a tiny 10% in the QLD turbo, but the vast majority is in our core QQQ engine. We're playing it safe. So why start so cautiously? Well, the data is telling us the market might be a little tired. The RSI, which measures momentum, is pretty high. Valuations are stretched, meaning stocks are kind of expensive. Plus, we're all waiting for that key data on jobs and inflation, not to mention what the Federal Reserve is going to say at their first big meeting. We're basically just waiting for some of that fog to clear before we hit the gas. Okay, so as we move out of that first quarter, the plan is to gradually start pressing on the accelerator. If the early economic data comes in looking good and earnings season gives us some confidence, it's time to start engaging that turbo. And you can see that shift happening right here on this chart. We're taking money out of our safe haven brakes and we're putting it to work. nearly doubling our position in the turbocharger QLD. We are consciously and deliberately dialing up the risk. And what's the result? A brand new portfolio mix with a target beta of 1.15. We are now officially positioned to be more aggressive than the overall market. The goal here is to capture what is historically a very strong period for stocks in the second quarter. And the reasons for the shift are pretty compelling. For one, April is historically the strongest month of the year for the stock market. By that point, we'll have all the earnings reports from the first quarter, giving us a really clear picture of how companies are doing, especially with the whole AI trend. Plus, the Fed's plan for interest rates should be way more predictable. A lot of that early year uncertainty is just gone. The second half of the year, well, this is where the strategy gets really tactical. This is all about navigating some pretty well-known seasonal turbulence, especially this dramatic, almost predictable swing between September and October. Just look at this contrast. It is night and day. In September, which is historically the worst month for the market, we slam on the brakes. We dial our beta way back down to 1 or even lower. Then, the second the calendar flips to October, historically the best month, we do a complete 180 and we floor it, cranking the beta up to its highest point all year, somewhere around 1.3 or 1.4. It really all boils down to this one simple but incredibly powerful idea. Look, history is never a perfect guarantee, of course, but ignoring such strong, persistent patterns year after year, that's like trying to swim against a powerful current. This strategy is all about working with those tailwinds, not fighting them. So, after we've navigated a whole year of defensive starts, mid-year accelerations, and these crazy, volatile swings, what's the big idea? What is the core takeaway from this whole game plan? This table really puts it all together beautifully. You can see that clear glide path for our beta target. We start cautious, we get aggressive in the middle of the year, we manage that nasty September dip, and then we hit the gas hard in October before resetting for the new year. It's a clear, repeatable process that's designed to work with the market's natural rhythm. And that brings us to the final, most important point of all. This entire strategy, this whole game plan, it's built on one idea. Having a disciplined framework for reacting to the market is way more powerful than trying to predict it. And that leaves us with a really interesting question to think about. In a world that seems to be getting more and more volatile, is a dynamic approach like this actually better than the old wisdom of just buying and holding on for dear life?